maybe we can see that as a retest. Now, take a look at this. This is now the second order effects, which are getting a lot of attention. It's the credit markets. These are ETFs tied to investment grade corporate bonds and then senior loans, big corporate bank loans. And obviously went vertical to the downside in the last couple of days. This is now that illiquidity issue that Mohammed was talking about, and it's now going to, I think, be front and center because once you get the sense out there that you can't sell what you want to sell, you sell what you have to sell. And, without being alarmist about the actual creditworthiness of businesses just now, we just don't know what to make of it. And you're starting to see a little bit of capital markets seizing up in certain areas, guys.
All right, Mike, looking closely at all these things, let's talk to someone who knows markets and technical levels, everything else. VIX, JJ Kinahan, Chief Market Strategist at TD Ameritrade. Surat Sethi is with us once again. JJ, your thoughts this morning?
Well, I think, Michael's talking about levels, et cetera. I think the biggest problem for most people as they look at this is that there's no end date. People like dates of things that are going to happen, et cetera. If you think about, if you draw the parallel to tariffs last year, there were days where we'd have big down days, et cetera, or big up days based on some news. And I think the biggest thing about that was there was always, well, if this doesn't happen by, like a July 1st or something, here are the consequences. The biggest problem for, I think most investors here is there is no date where you're saying, okay, well, we'll have an end or we'll have improvement by that. Everything's speculation. And I think with that, that's why it's making very, very difficult to price things. And so, the easiest thing to do when you're not sure what the pricing should be is to sell things, particularly on the back end of people having had, a few very nice years right now. So I think the biggest thing for, the retail investors who are watching at home is to, if you want to, if trading in this market is fine, but really cut your size. And if you're going to use stop orders, et cetera, really spread them out. We are having giant ranges every single day. There's no reason to think that's going to stop in the near term.
Surat, we spoke to you. We spoke to you earlier, so you don't have to have all new, insightful thoughts. You can summarize what you thought before and just add to that as well. Mike Santoli's here as well. But what do you think, Surat?
I think what JJ's saying is this uncertainty is just causing this negative euphoria that we've had, in January and December where everything was going up and people were following it. I think the volatility is incredible. The ups and downs are a lot. And for the average investor, to try to time this is just not the right thing to do. So really, this is the time that we've talked about for years where you take that long-term perspective. And I don't know, trying to get that home to a lot of people to say, we go through these things and that's the equity risk premium you have. And trying to chase the bottom is very hard to do. So it's really investing at this point takes patience. And at some point, the markets will reflect the reality that we have. And right now, they're going to overshoot on the downside and really stay within your allocation. And if you do have the capital, add to it over time.
David Bahnsen, founder and CIO at the Bahnsen Group, joins us on the phone. So just talking in strict numbers, David, and they're frightening numbers, obviously, but I don't know. A worst case scenario, there were people that said the market needed to go down 40%. So if we're down 22 already, are we, by definition, closer to a bottom than the top right now? I mean, that's another 18% would obviously be very, very painful. But what do you think the real range could be when it's all said and done, David? Even if and assuming it overshoots based on where it should be.
Yeah, of course, the first part is defining what it should be, and that's really difficult to do. It will become easier with hindsight in the future, but I think that 40% would be really extreme for a non-financial crisis. If we have this sort of transitory period of impaired GDP growth, you could certainly see further downside. But regardless of the exact bandwidth, Joe, I'm convinced that we're closer to a bottom than a top. And I think that what the prior guest said is exactly correct, that unfortunately for regular investors, their best defensive play is to wait through it.
All right. Santoli, it's all about duration, I think. I mean, that's what we're talking about, isn't it? How long we have profits severely impacted. Some of these industries, you're talking about profits down like you've never seen before. But if it's 3 months, you don't even annualize the 3 months. So that's kind of what we need to get our arms around, and nobody knows at this point. the epidemiology of the virus.
Market reflects people essentially surrendering to that lack of knowledge in the short term. Yes, I agree with you. If it's 3 months, the economy itself can make that up in large part,
right,
and not really be impaired that long. I think one of the issues the market is dealing with now is, as the clock ticks, we have companies structured that simply cannot weather 3 months of near no sales or something like that, and that's why you get the credit issues start to rise to the surface, and essentially, that kind of treadmill keeps running, even though you're not able to keep up with it on a top line side. So I do think that you have that issue right now. People are having to try to figure out. On the other hand, I mentioned that the market hasn't been, obeying any particular levels or anything like that. It's just going to more extremes. But the fact is, we are at massive extremes when you look at just exactly how washed out the market has been. 5 days in the last week or two where you've had, 90-95% of all stocks to the downside. Whatever you want to look at to say, whenever we've had these massive panics or sell-offs or bear markets or whatever you want to call it in 08 and 2011, you had these preconditions for it's going to take further incremental bad news to really, in a straight line, get it down much from here, but that doesn't really help you on a day-to-day basis.
Mike, does it help to point out December of 2018? I just don't remember the specter of just the horrific visions we're all having of the future right now weren't present in December of 2018, and we still haven't hit those levels yet.
But isn't that concerning to you? See, I turn it around and look at it the opposite.
No, I take solace in that.
If you could go down to
what number? Define your number then. Define your number then.
Hold on.
40? We've admitted 40.
I'm just saying, if you could go down 20% on fears of a recession in 2018.
Right.
And we're here. And
I'm not convinced the backdrop is
worse.
I'm not convinced the backdrop is. You're talking about a 1% mortality rate, which is awful. It's 10 times the flu. That's what we're talking about.
I understand. That's the medical issue. The economic issue is a terminal.
The medical issue determines how long the economic issue lasts, and if it doesn't, if it's 10 weeks like it's in China, you're assuming it's not going to be 10 weeks.
I'm not assuming it's 10 weeks. That's
right.
correct.
Okay. Fine. We know that.
But
you made that point.
We also have to understand two things, though. What happens during that 10? Let's say it is 10 weeks. How much business stops during that 10 weeks? That is something we also don't really know.
Everybody's watching the same things, and we understand
to me, the bigger concerning issue at this point would be if you're actually seeing trouble in the markets, the technical functions like Mohammed was talking about earlier, because that's the type of thing that just defies logic at that point. That's just the vicious cycle. And Mike, Sarat, I don't know if either of you have an answer on that.
But I think it's twofold here, Becky. I mean, you're right in the financial markets that have this uncertainty as to what's going on, which is kind of what Joe was referring to in December of 18. But then you have this consumer sentiment side too that we're talking about. It's a human element. It's a powerful 1-2 combination, and which is kind of that's what's really driving this market now. It's emotional at this point, where if it's 20, it could be 25 and 30. But to Sansoli's point, this is now very technical. Like this could just blow through the bottom here, and you could have a huge blow up and come right back up. So I think we're trading right now really not on anything fundamental, but just sentiment.
Rebecca, I do agree with you that just the financial market dislocations have now started to get to a point where we have to worry about not so much is the market going to function, but the gap's going to be bigger. Liquidity goes down.
Right.
And by the way, that's what people are saying. The Fed can actually come out and theoretically address those things on a functional basis in terms of these various programs. And this also is what we've tried to create some resilience in the system since 2008 and 2009. Now, the banking system, it seems like it has built up some cushion in terms of capital. But guess what? You build up the capital because you might have to burn it in the bad times, and that's what we could be looking at.
Here's the question, though. It would not be rate cuts that would do that. The Fed or Treasury could do something different. Maybe that would be even Treasury stepping in to buy Treasuries or something too.
Yeah.
And one thing I would say, guys, is looking at some of the places people, we talk about all this. What's confusing for people is where should I turn? What should I buy if I do participate in the market right now? One of the things we're seeing, I think that's interesting, is you're seeing people really turn to more, I'm going to call them almost old school stock that pay dividends, have weathered the storm before, so to speak. You're seeing people buying like Apple, Disney, Microsoft, names that may continue to go down, but I think people have more trust in. And so, someone made the point before that some of the shall we call them more high flyer stocks, are certainly things people are saying right now, I don't necessarily want to be a part of at the moment. I want to go somewhere where I have longer term and they pay dividends. I also think is a big thing for stocks that people are looking at currently.
Hey, Santoli, the market's open for trading today. You know what I mean? People can act on whatever their intentions are. What are the incremental things that you mentioned that could be that we haven't already sort of thought about that could take us the next leg down, in your view? I mean, anybody's free to do whatever they want right now. If we know we're going 30 or 40, right?
No, I mean, you're absolutely right. I mean, I honestly don't know if there's a particular headline that's going to do it. I thought at some points this week, it seemed like we were sort of trying to stress test the market for the news blows that were coming. And it was, I think, a sort of a mixed outcome on that. But right now, this looks a little bit like a paler version, what we might see today, of that 2008 failed TARP vote, where it was like the market's going to throw a tantrum because there's some specific response it seems to want from policymakers. Hasn't gotten it yet. It's going to sell first. A lot of collateral damage is going to be created that is probably undeserving in terms of economic or long-term corporate value, but that's just the way it works because, you didn't start this from a point where the market was soberly and cheaply valued and was building in a margin of safety, so now you have to build that up through lower prices.
Just one quick point. We've been talking about duration. Scott Gottlieb, who's been coming on this program virtually every morning now for the past several weeks, says, just put this on Twitter, we face two alternatives but hard outlooks. One is that we follow a similar path to South Korea or one closer to Italy. Right. You're talking about the South Korea one. Right. He says, we probably lost the chance to have an outcome like South Korea. Right. We must do everything to avert the tragic suffering being borne by Italy.
The longer we've gone, the good outcomes keep getting lopped off the end. The bad outcomes don't. We just don't know what's going to happen.
We don't. But I think that we need to be a little bit more circumspect about the idea that this is going to somehow...
Well, there's still...
I'm hoping that we find the drug, as you know.
It's not going to be necessarily just a drug, but there's a difference between 100,000 or 200,000 global cases and 50 million in this country. There's a difference. And I don't know whether we're going to... If you think we're going to 50 million, that's something that would obviously have a much longer duration. I don't know. There's something in between those two outcomes. Becky, what were you going to say?
No, I just agree with you. It's something in the middle here. We don't know exactly what it is. It's hard to say what the market's factoring in, but it is the other sort of stress factors on the market that concern me at this point, because I think at that point you're not necessarily paying attention to logic or even the headlines at that point. And
something doesn't smell right about China. Either
that will be interesting to see in 2 weeks.
They're totally wrong, or they're so draconian, and the communists can do things in terms of personal liberty that we're unable to do here. But I just can't believe that where it started, we're still at less than 200,000 cases globally. I
agree.
And China has somehow gotten a handle.
They've released those draconian measures. Well, they've released the draconian measures. People are going back to work. We'll see in a couple of weeks if it picks up again, or if we're getting accurate reports, because that's been the other question. Have they been reporting accurately? Will we get those numbers? We'll be able to watch other factors that we've been watching all along, factory production, watching traffic and activity on the streets. But I do think that's a very fair point, Joe, and we'll see in a couple of weeks whether it's been effective.
We will. Yeah. Time will tell.
All right. Thank you guys for joining us to talk about trading. Let's give you some breaking news from the travel industry right now. Officials say that a JetBlue passenger on a flight that was traveling from New York to Florida last night has tested positive for coronavirus. That plane was stuck on the Palm Beach tarmac for about 3 hours because of a medical emergency. The local health department spoke to all passengers on the plane. Those passengers were allowed to leave the airport and were told to call the health department if they had any medical concerns. We have calls into JetBlue, and we'll bring you more as we have it. Unclear about what that means, if people would be self-quarantined, if they'd been asked to do that, but we will continue to follow this story. The full impact of the coronavirus is yet to be determined, but one industry may be prepared to weather the storm, and that would be the insurance business. For more on the risks, we're joined right now by Eric Donalo. He's Executive Vice President and Chief Legal Counsel at the Guardian Life Insurance Company of America. Also, of course, the former Superintendent of Insurance for New York State. And Eric, it's great to see you. Thanks for joining us.
Thank you. And also, I've recently rejoined the law firm of Debevoise and Plimpton.
Of course.
Good to see you.
Right. Good to see you, too. Eric, let's talk a little bit about how the insurance industry is prepared on two fronts. First of all, what kind of liability do they have for any of these canceled events, other issues that are taking place? And then how are they prepared with their own investments? Because when you see these huge moves in the Treasury markets, obviously that concerns us about pension funds, insurance companies, and others. So let's start with the risk at this point. What's the situation look like?
So I just think compared to 10 years ago, insurance companies are in a fundamentally better place. They're much more diversified. They're much more liquid. They have the highest order of risk management in place, and I think that their capital standards are even higher than they were 10 years ago. The regulators have insisted upon what's often called redundant reserving or excess reserves. So I think fundamentally, as an ability to make good on their liabilities, the insurance industry is in a very good place. These conditions are the exact conditions that they stress test for, they reserve to, and they work with the regulators on being able to make good on their obligations. But I would say that you could see insurers start to get more and more into fee-based businesses, get into more short-dated obligations. I would think that they're going to consistently think about getting rid of sort of core, non-core businesses for them in order to really, really focus on having as much capital for their obligations. On the asset side, so to speak, they have, in fact, I think, been increasing the quality of their assets. But I think in order to get a little more yield, you're going to see trends towards more real estate, CLOs, CFOs. I could see them partnering more with private equity to improve some of their capital positions. This is also a good time, in fact, for them to go to a market on debt offerings because they're very highly rated and they can bring in, $500 up to $1 billion and promise a fairly low interest rate on a horizon of 50, 60, 70-year repayment. Also, this is a time they are buy and hold companies, so I could see them going deep into the market and looking at compressed or challenged quality of assets and just loading them on. That's been a consistent theme in the last several years for insurance companies. So I'm actually very optimistic about their positions. There will be, as you say, there will be pressure, which we can talk about, from the inevitable claims around the virus, from the potential for business interruption on the property and casualty side. But I feel like the industry is well capitalized and prepared for that.
I guess my question would be, if they've already gotten a little riskier by trying to get more yield by going maybe more into stocks or something, if you're trying to get more liquid right now to potentially pay claims, it's a lousy time to try and be selling when you're already down 20%.
Yeah, but my point is that if you look at what they're permitted to invest in, like 90% of the pie is extremely conservative, high-grade debt, bonds, et cetera. The regulators require the premiums to be in those kinds of instruments. I'm talking about getting like a marginally better yield, but really, really, really a huge number of the book. And it's also done under what's called statutory accounting. We've talked about this before, as opposed to GAAP accounting, which tends to be very, very heavily capitalized and very good about riding out short-term volatility against a long-dated match of liabilities and assets.
One thing that Mohamed El-Erian talked about with us earlier this morning is just how you are seeing markets that had been incredibly liquid, places that you wouldn't have seen liquidity in the past, but we've poured so much liquidity into the market, and now some of those places are actually drying up. Is that a concern for any of these things? Should I not worry about insurance companies there? Or, what you've said so far sounds very reassuring. I'm
not worried because I think they've already put themselves in a very, very liquid position. The other thing to take into account is while interest rates have dropped, quite a bit recently, there's been a downward trend now for a long time, and insurance companies have seen that. They've reacted to it. They are poised for a long time of lower interest rates. It's not as if it just fell off the table overnight from their perspective.
True. Eric, anything else you're noticing right now? Anything that concerns you just about the markets that we're watching, let's say, over the last 2 weeks?
Well, I think there's going to be some, debate, so to speak, among the regulators and the companies on a variety of things. You can already see the regulators reacting, sending out inquiries. New York State Department of Financial Services has something on its website now asking the companies about their business continuity and readiness. Although I think from having been inside of 3 companies so far, they are absolutely well placed for business continuity and be able to work remotely, et cetera. I think that the regulatory oversight has been helpful in that, again, the companies are very, very well capitalized. I do think that there'll be inevitable fear, which I just heard on the previous segment, about morbidity and mortality claims at the companies. But I want to emphasize that along with the capitalization that I think they've done really well on, they're also excellent risk managers. So they have factored in and stress tested for pandemic and epidemic for over 100 years since the Spanish flu. And I think that while people are appropriately very scared, they should be reassured that the industry is well placed both on the life insurance and the property and casualty side for these extreme events. That's why we have insurance. That's why people buy insurance, and that's what the industry is there for.
Eric, thank you very much. Eric Donalo, again, who's the former superintendent of insurance for New York State with Deb Bevois in Plimpton. Appreciate it.
All right, Beck, thanks. Coming up, former Health and Human Services Secretary Kathleen Sebelius will join us to discuss the outbreak and the government's response. Squawk Box coming right back.
Time now for today's Aflac Trivia question. When was OPEC founded? The answer when CNBC Squawk Box continues. Going upstairs and put down by Gafford.
The NBA is on TuneIn Premium. Each week, TuneIn picks an NBA game you just can't miss. Rising star Jason Tatum and the Boston Celtics are in Milwaukee to take on Giannis and the first-place Bucks.
Giannis, posting, poked at, spinning, fading, jump shot, nailed it!
Today, the Celtics are in Milwaukee. Tip-off is at 8 p.m. Eastern. Search NBA to follow your favorite team today.
And we created the Veridesk to improve the way people work. Over